Welcome to Emerging Markets Weekly. I am Nick Pardini with Nomadic Capital Partners, and welcome to the show. For the week of February 8th, 2013, let's get started with the news. There's quite a bit of market-making news this week in emerging markets. The first main market-making news is price controls in Argentina. Basically, what's going on in Argentina is that they are desperately trying to curb hyperinflation, even though it's the government that is causing the hyperinflation. But you know what? They're going to try, and they're going to fail, and this next stage is a failure once again. Basically, what they're doing is they're adding a 2-month suspension of price increases at all grocery stores. This may boost the sales of grocery prices for the next 2 months, but it's not going to do anything to stop hyperinflation from occurring in Argentina. Price controls are just the fourth of many steps the government tries to do to block its inflationary policies. First of all, let's start with why the inflation comes in the first place. The reason why it comes is because populist politicians in Argentina run for office, and as part of their election promises, they promised a lot of generous social programs to lower class and working class Argentines. They realize that these promises cost a lot more than the government has ability to spend, and as a result, they print pesos to finance these expenditures. Due to the increased money supply and a lack of confidence in the government, the price level increases, and you get inflation. This has happened in Argentina several times in the 1970s, the 1980s, 2001, and likely to happen again this decade. They started to try to block it through capital controls. Argentine pesos are heavily regulated, the flow of currency in and out of the country. In addition to these capital controls, they basically have banned the use of the U.S. dollar as legal tender in Argentina. So all transactions must be done in pesos in order to prevent people from circumventing the currency. Then they've had passed trade protection barriers to pretty much limit any possibility of a trade deficit in order to keep trade surpluses artificially high. The next stage involved with this is these price controls related to groceries, but none of it's going to work. It's going to result in hyperinflation. The peso was at 3-1 at the end of the last hyperinflation, about in 2002, and then now it's at 5-1 with the official government rate. It's actually above 5-1, but if you go to the black market rate, it's over 7-1. So it just shows you how far the currency has fallen, and this is in the scope of a weakening U.S. dollar. In addition to that, and private economists estimate inflation is 30% in Argentina. So that shows you right there that the inflation is here, and it's been over 20% since 2011. So it's only accelerating. The concern now with Argentina is what should investors do? Basically, investors should not invest in Argentina equities because their real value in dollar terms is likely to decline. They should not invest in Argentine real estate because the economy will weaken with hyperinflation in Argentina. And they could short the Argentine peso if they can get an effective borrow and an effective counterparty on the other side of the trade, which is going to be hard to do with a rapidly falling currency. But if you can, that'd be a pretty good trade. The other way to make money in Argentina investments is to possibly buy Uruguay real estate, because that's what wealthy Argentinians use to hide their assets or preserve their purchasing powers. They'll buy real estate across the Rio de la Plata in Uruguay, because Uruguay has a much more stable financial system and also has just a much more stable government. And so, as a result, it's a good store of value to hold your money in Uruguayan real estate. The other thing when it comes to Argentina is that I just don't recommend investing in it until Cristina Kirchner is out of power and somebody who's more hawkish and serious about price level stability gets elected. Argentina has a bad track record. It's one of the worst in the world in terms of monetary policy, mainly because of this populist politician problem that I talked about previously and the fact that they don't have an independent central bank. So Argentina is going to be a bad investment for a while. However, there will be a buying opportunity, and I'll update followers on that when the time comes. The next news story is India falls short on growth estimates. GDP is expected to grow 6% in India those expectations have been slashed to 5%. I talked about this last week, but my outlook is still pretty pessimistic on India. It's got high inflation, it's got overpopulation problem, which population is skewed by the India bulls as a good thing, but population growth can be a bad thing if there's not enough job opportunities to make up and for an advancement to make up for the increase in population. It can just simply lead to unrest when you have a bunch of people with nothing to do and no prospects. Look at the Middle East, for example, with the 2011 Arab Spring in places such as Tunisia, Libya, Egypt, Yemen, Bahrain, etc. There's plenty of religious and ethnic tension just within the country itself, along with geopolitical issues with its neighbor in Pakistan. And that's not good for the economy. Infrastructure is bad. There's not enough roads to support internal trade within the country. There's not enough electricity or energy usage or energy facilities to be able to support supplying people with electricity or sufficient air conditioning or other utilities for 1.2 billion people. This was shown by a power outage last year. And their government is slow for market reforms. Even when Prime Minister Singh passed recent reforms in the financial and retail sector, they were heavily resisted by opposition and even members of his own party. So it's going to be very hard for the Indian political elite to give up state control of industry, as that has been something that's been a mainstay since the country's independence from the British Empire. Just as a disclosure, I am short India through the PIN ticker symbol ETF. That's the PowerShares India fund. And I just think it's going to continue to underperform other emerging markets. And inflation is high there too, as we talked about last week. So there's really not that much going for it right now. A final news story is labor unrest continuing in South Africa. South Africa has a lot of problems in terms of its labor structure. On the high end of the labor structure, you have a brain drain. Higher educated ethnic minorities, usually of Asian and white descent, are moving out of the country shortly after college graduation to get jobs in other English-speaking countries such as the U.S., the U.K., Australia, and Singapore, because they don't want to deal with the affirmative action laws that prevent them from getting the jobs that they would like to have at home in South Africa. High crime rates are also driving educated people of all ethnic backgrounds to move out of the country as well. On the lower side, you have artificially high wages due to union pressure. Unions are very strong in South Africa, and there's been numerous strikes in the mining and the farming sectors, mainly involve platinum mines, but it's spread to other parts of the economy. And these strikes are effective due to the strength of the unions in these countries. And as a result, their wage scales are way higher than the rest of Africa and many of the other emerging markets. So as a result, their labor is uncompetitive. This has made manufacturing in South Africa pretty much completely uncompetitive to foreign markets. And it's made other resource extraction businesses, such as mining and agriculture, a lot more expensive and increases the cost, which hurts the profitability of these mines and farms and the overall GDP growth of South Africa. I mean, and another byproduct of these union presence is high unemployment rates in South Africa. South African unemployment is one of the highest in the world. It's over 20%. And this could be also one factor, is that the closed shop unions keep a lot of people out of jobs in the lower end of the job curve. So I just think until South Africa fixes its labor issues, they're going to continue to have problems. I mean, the ways we make trade this is going long platinum or going short the rand. But there will be a time to buy South African equities. It's just not right now. And then we're going to talk about when it comes to investing in Indonesia. And that's what our next of our four markets we thought would be breakout markets for 2013. We talked about Vietnam last week. Chile and Mexico we'll cover in the future. But for this week, we're going to focus on Indonesia. There's a lot of bullish drivers for Indonesia. The main bullish driver for Indonesia is the fact that its growth is mainly internal and less sensitive to weakness in developed markets. Indonesia is not an export hub of manufactured goods to the United States or Europe. Most of its own growth is from domestic consumption of its own people. As a result, if the United States falls into recession, which I think is likely, and Europe's recession continues to worsen, Indonesia will be able to not suffer as much of the losses because their economy is not dependent on it. And if global risk markets drive Indonesian stock prices down just as much as the S&P 500, then it may be the buy of the decade. But I think it's going to fall less than the S&P 500 over the next correction that is bound to happen. Another thing about Indonesia is it's a popular tourism destination. It's a cheaper alternative to China for manufacturing as well. Tourism in Bali, actually, surprisingly, domestic tourists have passed up Australians for the most popular tourist spot group of tourists at the island, which means that domestic tourism is growing across Indonesia as well. And in addition to that, you see more visitors coming from places such as Australia, Singapore, and to a lesser extent, China, Japan, Malaysia, and South Korea. So tourism in Indonesia is growing, which is a bullish factor. With labor costs the way they are in China, that some places as high as $800 a month in coastal provinces. Factory labor is much cheaper in Indonesia. You can hire a factory worker in Indonesia for less than $1,000 a year. So the thing is that with these cost differences going on in the country, you've got a lot more opportunity for manufacturing to grow in Indonesia, and that's what's happening. Textile factories are moving from China to Vietnam and Indonesia and other ASEAN countries where the cost is much lower. So that's a bullish driver. Demographics are also extremely favorable in Indonesia. It has a growing middle and upper class, a lot of people who are buying things such as toothpaste or cars or motorbikes or houses for the first time in their lives, and as a result, this surge of first-time buyers is creating an economic boom in the country. In addition, the housing market is actually affordable for Indonesians. I mean, their yield is one of the best in terms of rent yields in the world. It's 9.8% in Jakarta, and about 10% for the country as a whole, compared to the United States, where it's about 4% rent yields. And therefore, that means prices are low, and Indonesia has a lot of potential for a housing boom because you're going to have more people affording houses, and housing currently is at even affordable levels for somebody on an Indonesian level salary. So there's a lot of room for growth in the housing market in this country. The other thing is that half the population is young. It's half the population is under 30, which also can drive housing because there's going to be more young families in Indonesia. But in addition to that, the improving demographics and growing middle upper classes on the higher end will also promote more investment in the country's stock market and the country's real estate market. And the reason for this is because Indonesia has the highest growth rate of high net worth individuals in Asia, and maybe even in nominal terms as well, in terms of number of new high net worth individuals are coming from Indonesia. So you're starting to see a set of nouveau riche in Indonesia, which will help drive the value of capital markets and prosperity in the country as a whole, as these people reinvest into their country. 60% of GDP is from domestic consumption, so that's basically, they're not as export sensitive as the rest of the emerging markets, which I think is a very bullish driver. However, in Indonesia there are risks as well. There's a historically weak rupiah. Even with a falling dollar, Indonesian rupiah has continued to decline. I mean, it's declined from 9,000 rupiah to the U.S. dollar to 9,700. The reason the denomination is so high in the first place is because of several rounds of high to hyperinflation in the 60s, 70s, and recently during the Asian financial crisis. So they don't have the best track record of keeping a currency value up. And the reason this means to investors is bad is because if you invest in Indonesia, your returns may look great in rupiah terms, but if the rupiah keeps falling against the U.S. dollar, or whatever country my readers are from that has a stronger currency than the rupiah, then you're going to lose in terms of your currency. So like you may gain, the stock may go up 20% in rupiah terms, but if the rupiah declines 20%, you don't really gain anything. And that's something to watch out for because currency debasement is a problem in Indonesia. The other thing also is Indonesia is now a net oil importer. They used to be one of the big world's oil exporting countries ever since their discoveries first by Shell about 100 years ago. However, now with increased domestic consumption, Indonesia is now a net oil importer. This has transitions trade surpluses into trade deficits, which is negative for the rupiah as a currency due to negative capital flows. And in addition to that, you have more, concerns when it comes to the gas subsidies. I mean, fuel subsidies can bring gas prices in Indonesia to prices that are 50% of the United States. And as a result, if you get rid of those due to less abundant oil supply domestically, that may hurt domestic consumption and be bearish for Indonesia. And the final thing is corruption. Indonesia is ranked 118th out of 176 on Transparency International's Corruption Perception Index. This is a very weak number. I mean, 1 is the least corrupt, so that means Indonesia has a long way to go before it's a clean country. However, if the direction is more important than the absolute ranking here, if Indonesia can clean up and improve it, the degree of corruption by reducing it, then this is a bullish index. But if corruption stagnates or gets worse, then this can be a very bearish thing because it's going to prevent foreign investment in the country. Let's just look at the IDX, which is the leading ETF for Indonesia. It's rallied quite a bit, but it's still off compared to the other overbought indexes such as the S&P 500, which would actually make it a good buy if it could successfully hold support at around 2775 on the index, and then the next level is 2650, which I'd be buyers of this at both levels. However, like most of the equity markets in the world, it's a little bit overextended here, so I wouldn't buy at this point. However, if you want to know for exact timing, you could follow our Emerging Opportunities subscription program. And then thank you for watching this video this week. Stay tuned next week as we break down how to invest for the transition of China to a consumer-based economy and cover more emerging market news. The Emerging Opportunities newsletter will be available next week. Basically what that is that it's a premium research service for people who are not investors in nomadic capital partners, but would be interested in learning more about how to invest directly in emerging market equities and in the emerging technology sector. We have videos like these for both emerging markets and tech, along with plenty of trade ideas, portfolio trackers, so you can follow exactly when Nomadic's portfolio enters a specific or exits a specific trade. It will have macro reviews and more detailed analysis for all the research that we do for our private investors. Starting next week, we'll still have these videos on YouTube, but we'll only have the news section. All the rest of the content of the Emerging Market Weekly will be restricted to only subscribers to Emerging Opportunities newsletter or the Emerging Market Insider Premium Edition, which is at discount price, the only emerging market content. It won't include tech. So you fans who are only interested in learning about these emerging markets, Emerging Market Insider Premium is the product for you. I look forward to speaking to you again next week. Thanks.